Okay, okay guys, we have discussed the theoretical part of the standard IFRS 5, and that is non-current asset held for sale. Now we will discuss some uh, numerical or number crunching here. Okay, so we have an asset, and that is okay. Before we doing this, let me write for you to be simple. First, what we will do depreciation. Then if we have revaluation, then we will do revaluation. Third, before classification is held for sale, we will do impairment testing, and that will be under IS 36. Okay, if we done this, then we will do shifting entries, and the fifth thing that we will do is after classification impairment testing. Okay, and that will be under IFRS 5. Clear? So let's start the question. Okay, the entity purchased a machine on 1st January 2002 for $100, and the useful life is 10 years. Now on 30th June 2004, board decided to sell the asset or condition held for sale. It means that we have to do depreciation from 1st Jan 2002 till 30th June 2004. Now here, if you see, we don't have any depreciation method, so we assume that we have to use straight line method. Okay, we know we need scrap value for straight line method. So if we don't have any scrap value, so we again assume that the scrap value is 0. Okay, so let's start. On 1st 2002, cost is $100. Now we will calculate the depreciation for this year, and it will be $100 divided by 10, and scrap value is 0, so it will be 10,000. So it means 31st December 2002 carrying value is 90,000. Again depreciation for another year, and it will be same like 10,000, and on 31st December 2003 the carrying value will be 80,000. Clear? Now for 6 months we will calculate the depreciation, and it will be like 10,000. 6 divided by 2, so it will be 5,000. Clear? So it means on 30th June 2004, the carrying value will be 75,000. Clear? Now on this date, the board decided to sell the asset in all condition or held for sale were met. So we have done depreciation. Now after doing depreciation, we will do before classification. We will do before classification and impairment testing, and that will be under IFRS and under IS 36. So before classification and impairment testing under IS 36, and we know that recoverable amount under IS 36 will be higher of two figures. The first one is value in use and the second one is fair value less cost to sale. Okay, now if you see here on 30 June 2004, 72,000 is the value in use and fair value less cost to sale is 65,000. Now on this date the carrying value is 75,000, this one here. So this date is 30th June 2004, all for same. Now if we take the higher amount, so the higher amount is this one. Okay, now we compare this recoverable amount with this figure, and it means that carrying amount is greater than recoverable amount, so we have depreciation of profit or loss, debit, profit loss, credit, and the credit will be property, plant and equipment, and the difference between these two figures is 3,000. That means that is the depreciation. Okay, now we have done the depreciation, then we done before classification, impairment testing. Now the third point is we have to do some shifting entries. So for shifting entries, we are, what does it mean? It means that we are now shifting the asset from non-current asset to current asset, mean non-current asset held for sale. So let me write the shifting entry. I think this is a fine number 4. Shifting entries. Clear? So debit will be non-current asset held for sale and credit will be property, plant and equipment, and that is machinery. Okay, the value we use is 72,000. At this amount we are now shifting. Clear? Okay, once you complete this, then you have to do after classification. The fifth one is after classification, impairment testing, and that will be under IFRS 5. And if you remember, under IFRS we record at lower of two figure, carrying value and value in use. Oh, sorry, not value in use, because we are not using the asset but we are actually selling the asset, so it will be fair value less cost to sell. Okay, now the fair value is okay. Now the figure carrying value is 72. This one figure. Clear? But on this date, let me check the on 30 June 2024, the fair value less cost to sell is 65. So I write here 65,000. Okay, now till this we have to record lower of If we record lower of these two figures, then the lower figure will be this one. So it means we have impairment of about 7,000. So debit will be profit or loss and credit will be non-current asset, but this will be held for sale non-current. So the figure will be 7,000, mean the difference between these is 7,000. Okay, now the fair value less cost to sale on 31st December, because we don't have further depreciation, so will be this amount. This amount is on 31st December 2004. Okay, now on 31st December 2004, fair value less cost to sale is this amount. Okay, now the difference between these two figures is about 65 minus 59, so it will be like 6,000. So mean we have further impairment of 6,000. So means debit, profit and loss and credit will be non-current asset held for sale by 6,000. Okay, if you see here on the 1st March 2005, the values goes off to 85. Now what you will have to do is the maximum reversal which you need to do, and the maximum reversal of impairment is limited to the amount of total previous impairment. So the previous impairment, if we calculate, is the total previous impairment. Now the first impairment is, I think, let me write here, wait. The first impairment is this one, then we have this one with another impairment. I think we have another impairment on, if yes, then where is it? 3,000. Then here 7,000 and 6,000. So the total impairment is 3,000. Wait. Okay, here 3,000 plus 7,000 and plus 6,000. So it will be like 16,000. It means that the maximum reversal will be limited to limited to 16,000 only. Okay, this question has completed. Now let's move on. We have another question. We have to follow the same criteria for this question also. First we will do depreciation, then we will do revaluation if there is any revaluation, and then we will do before classification, impairment testing under IAS 36. Then we will do shifting entry, and after that you will have to do after classification impairment testing, and that will be under IFRS 5. Okay, the question is very simple. Here we have again a question, and this is a machine. We bought a machine and on 1st Jan 2005, and the amount is $100. Okay, now the useful life is 10 years. Now the company computed the recoverable amount of machine is on 31st December 2006, means that you have, because impairment hand. Now the recoverable amount on 31st December 2006 56, On 1st December 2007, the board decided to sell. Me on this date, the board decided to classify it as a held for sale. So before we go there, we had to do depreciation. Now on first two on first 2005, the cost is $100. Clear? Now the depreciation for this year is $100 divided by 10 because useful life, so it will become 10,000. Okay, now on 31st December 2005, the carrying value is 90,000. Okay, and okay, now again we have depreciation for another, and this depreciation will be the same, 10,000. So mean on 31st December 2006, the amount will be 80,000. Okay, if you see here, the computed recoverable amount on this date is 56. So means recoverable amount is become now 56,000. So it means we have impairment of 24,000. Mean debit profit and loss, and credit will be property, plant and equipment, and this will be 24,000. Clear? Okay. Now you see the board have decided on 31st December 2007, so we have to continue the depreciation on the new amount, and the new amount is 56, and depreciation on this amount, the remaining useful life is 8 years, so depreciation will be 7,000. So it means that carrying value on 31st December 2007 will be 56 minus 7 will be 49,000. Now on this date, the board have decided to classify the asset held for sale, and we know that once you are classifying the asset held for sale, then you have to do before classification impairment testing. Clear? So before classification impairment testing, and that will be under IS 36. And here we have recoverable amount is higher of two figure, value in use and fair value less cost to sale. Clear? And the carrying amount here we have 49,000, this amount. Okay, and value in use on this date is, and the date is, you remember from the question, is 31st December 2000 is 40. This is the value in use. Value in use is 40,000, and fair value less cost is 35. And definitely we'll take the higher figure, and the higher figure is this one. This is the recoverable amount, and if you compare the two figure, these two figure, then the carrying amount is higher than this amount, recoverable amount, so we have impairment of 9,000. So debit will be profit and loss, and credit will be property, plant and equipment by 9,000. Okay, now after doing this, we have to do the shifting entry, and this is the stage number 3. Let's do 3 shifting entries. So debit will be non-current asset held for sale and credit will be property, plant, equipment. And the amount on which we record will be 40,000. This one amount, Okay, after completing this step, we have to move on, and the fourth step is after classification. After classification, impairment testing, but that will be under IFRS 5, and this we had to record at lower of two figure. The first one is carrying value and the second one is fair value less cost to sale. We are not using here value in use. This is the recoverable amount. We are not using value in use because the asset is not for using. The asset is held for sale. So the carrying amount here is 40,000, and the fair value less cost to sale, let me check from here, is 35,000. Okay, and if you check here, the lower figure is this one, so we will use this figure, and the difference between these two figures is 5,000. So the asset is again have impairment. Asset has impairment of 5,000. So I will write debit profit and loss, credit non-current asset held for sale by 5,000. Okay. Now if you check at 31st here on 31st the asset goes off. Okay, when asset goes off, then we will need to reverse the previous impairment, but the maximum reversal is limited to the previous impairment, total impairment. Now the total impairment, if you check from here, the first impairment was here. Let me check here. The first impairment. Okay, here the first impairment was this one, and then we have second impairment, and this is the third impairment. So we have total 3 impairment. Okay. Now one thing you must remember, that if you check, the depreciation was first 10,000, and after revaluation the depreciation from this amount is reduced to this amount. So this is the reduction and depreciation, and that will be 3,000. So this benefit is already taken. Now we have here the total impairment, and the total impairment is 24,000 plus 9,000 plus 5,000 less the 3,000 reduced depreciation. We have to deduct the previous or the reduced depreciation. So the amount will be 35,000. So it means that debit will be non-current asset held for sale, and credit will be profit and loss, but the amount will be 35,000. Okay, 35,000. Now the asset will be reported at what amount? The first amount is this one, 35,000 plus this amount, so the total will be 70. The asset will be reported at 70,000. Okay, now we have done the cost model, and the last one we have revaluation model, and we have to do again the same step. We have to follow the same step for this question also. Okay, now you see here, company purchased machine for 10,000 on 1st June 1st. This is not June, but let's say this is January, and the useful life is 10 years. The asset was revalued first time on 31st December 2002 to 120. Now the fair value on the same date, no, after 1 year, is this one. On this date, the criteria of being classified as held for sale is made by the asset. Now cost to sale at that was 9,000 and value in use amount is this one. Okay, first what you will do, first you will do depreciation. Now first chain 2001, cost is $100, right? And the depreciation for this year is 10,000. Okay, now on 31st December 2001, the carrying value is 90,000. Now again you have to do depreciation for the second year, and that will be the same as the previous. So the value on 31st December 2002 is 80,000. Now on this date, the asset is revalued to 120. So it means we have revaluation surplus or revaluation reserve of 40,000. So debit will be revaluation reserve and credit will be property. Sorry. Wait. This is the revaluation, so debit will be the asset. Debit will be the property, plant and equipment, and credit will be revaluation reserve, and the amount will be 40,000. Now okay, now after the depreciation will be continued on this new amount. Okay, and using the remaining useful life. So 120 divided by 8, so the new depreciation will be 15,000. And now on 31st December 2003, the carrying amount will be 120 less 15,000 will be 105,000. Now on this same date, on 31st December 2003, the fair value is 100. So mean the asset is devalued by 5,000. So we'll first entry debit revaluation reserve, and credit will be the property, plant and equipment. Clear? By how much? 5,000. Okay, this is the cancellation of the old revaluation reserve. Let's move on. We had to do another step, and that is that step is before classification. You see here on this date, mean on 31st December, the asset is classified as before classification. Before classification, we will do impairment testing, but that will be under IS 36. Okay, and we remember that under IFRS 36 the recoverable amount is higher of two figures: value in use and fair value less cost to sale. So the value in use here is 15. Yes, 15, you see, 15,000, and fair value less cost to sale, so the fair value is 100 and less cost to sale is 9,000, so it means that is 91,000. And if we take the higher figure, so we will take 19. Now the carrying amount on this date is 100, mean this one fair value, and it means that the recoverable amount is higher than this amount, so there is no impairment. No impairment. Clear? Okay, if we just continue, then we have to do another thing, and that is shifting entry. Shifting entries. Okay, and shifting entries, you have just to shift the asset. So the asset will be non-current asset, held for sale will be debit, and credit will be the property, plant equipment, and the amount will be 100 and 100, the carrying amount. Now once you complete this after classification, okay, after now the fourth thing is after classification, impairment testing, but this will be under IFRS 5, and we know that we record at lower of carrying value and fair value less cost to sale. So the carrying amount is 100 and fair value less cost to sale, fair value less cost to sale is here, here fair value is 100 and cost to sale is 9, so mean 91. Okay, so this will be the 91, and we record at lower of. So if we record at this amount, there is again impairment, and the impairment will be debit, profit and loss, and credit will be non-current asset held for sale, and the amount is 9,000. Clear? Now if in the future if we reverse, then we will limit the reversal to the maximum previous impairment. So this is just number crunching. We have done cost model first, Okay, then I have done the revaluation model for you guys, and the technique is very simple. First you have to do depreciation, then you have to do revaluation if you are using revaluation models. Number third, before classification, before classification, impairment testing, but this time you will use IFRS 36. After that you will do shifting entries. Shifting entries mean you are shifting the asset. And number 5, you have to do after classification impairment testing under IFRS 5. So this is the basic idea on which you have to solve the question. Thanks for watching. We will just meet in another video, another lecture, the part 3.